What's going on, Investomaniacs? Your boy Knight Rider here, and we're back with another Robinhood stock market update of the day. I can confidently say I did not see this one coming. Arizona iced tea, yeah, that Arizona iced tea is coming out with weed gummies. Whoa, everybody just be jumping on that weed bandwagon, aren't we now? Markets are still recovering from Monday's worst day drop of the year. Now, Uber reports earnings today, fresh after Lyft. Up first, turns out that Sam Adams isn't really a beer company, at least not anymore. Carb problems, anyone? Beer feels all those gluten, carb problems everybody be having nowadays. Declining beer sales is nothing new. Beer is now under 50% of all alcohol consumed in the U.S. Boston Beer Company is obsessed with ales. It owns Sam Adams, just bought IPA fan Dogfish Head, and often touts its beer-approved craft status. But research firm IRI recently released a report with this statistic. Only 25% of Boston Beer's biz is actually beer. That's right, 75% of Boston beer isn't beer. That's why it's important to understand what the company does and how it makes money, because sometimes company names can be misleading. This can be sometimes because they just change organically over time, or sometimes it can be due to acquisitions. Boston Beer's new profit puppy is super clear. Truly hard seltzer. The citrus-infused, gluten-free option has been Boston's summer tailgate champion, driving the company's 21% increase in shipments last quarter. Here's the rest of Boston Beer's non-beer beach beverage roster. Truly, sorry, but any triple-digit gainer deserves to be mentioned twice. Its sales surged 163% last quarter from the year before. Twisted Tea, the hard iced tea, sat back and enjoyed 22% sales growth. Mwah! Angry Orchard Cider just came out with a rosé option because, let's be honest, women love buying anything called rosé. Other non-beer bets, a hard kombucha called Tora, and a craft hard tea that goes by Wild Leaf. Ooh, I like that name for a hard tea. Wild Leaf. Yeah, I like that. They won with that name right there. What's the takeaway? Pure beer stocks are disappearing. Boston Beer isn't really a beer company any longer. Corona-owned Constellation Brands is big on whiskey, vodka, CBD-infused experimental beverages with a large stake in Canopy Growth. Budweiser owner AB InBev is also investing hard in non-beer options like Babe. See, look at that, Babe. They have rosé too. I'm telling you, man, chicks dig stuff called rosé. They're just like, just give me some rosé. Hey, if you want to pick up a girl nowadays, your game's got to be on point. It's got to be 21st century, you know what I'm saying? It's got to be woken. Like, would you like to come back to my place for some gluten-free cauliflower pasta, rosé, and ask for permission first, totally consensual touching? Also, I don't know if this is a real billboard or not for Babe, but if it is the most awesome billboard ever made, both extremely risky and totally fabulous. Meanwhile, Molson Coors dropped last week because it's overly dependent on Coors. That's right, the traditional beer. The beer legends that are succeeding today do it by trading what's on tap for what's light, fruity, or cannabisy. Also, check out how extremely targeted these two ads are. You have the traditional man beer. Yeah, it's that manly man, Jean-Claude Van Damme, with the mountains in the background because we're men and that's what we do. We kick butts and climb mountains. Why? Because they're there. And then you have chick beer with some dolled up Instagram famous model laying on a beach, because apparently that's what women do. They lay on the beach in full makeup because that's what women want. They want to lay on the beach and take pictures and send it out to their millions of Instagram followers. Guys, both of these, this is targeted advertising right here. Up next, 35 states just rejected a $10 billion settlement from opioid distributors. These 3 drug dealers are getting sued by 35 states. The stocks of McKesson Corp, Cardinal Health, and AmerisourceBergen fell on a report from Bloomberg that they offered $10 billion to settle opioid lawsuits, and apparently that wasn't nearly enough. There's plenty to blame for America's opioid epidemic. Purdue Pharma invented and quite aggressively marketed the addictive oxycodone, while doctors share blame for overprescribing it. And let us not forget, us, the consumer, also shares blame for not being educated about what we are putting in our bodies, even years after oxycodone was known for its dangerous and addictive qualities. But there's also these 3 little prescription drug distributors. They hook pharmacies up with the pills. That's right. They're like the drug dealer's drug dealer. It's where your drug dealer gets his drugs from, the distributors. Here's why that $10 billion they offered ended up not being quite enough. First, the allegation. 35 states believe the drug distributors turned their noses to what was obviously a dangerous problem. The painful example: some U.S. counties have over 100 opioid pills distributed per person per year. That includes children, people. In some areas, it's much worse, like in Norton, Virginia, which received 306 opioid pills per person per year. The counter, instead of accepting a $10 billion settlement, these 35 states proposed drug distributors pay up to $45 billion. Big difference there. The takeaway: what matters to stocks isn't when it becomes official news or when the lawsuit actually settles. It's when the news becomes credible enough for investors to begin worrying seriously. Investors reacted fast to Bloomberg's report because it is a credible source, thus dropping the drug distributors' stocks. So, by the time an official verdict is reached, the fine could already be baked in to the drug distributors' stock prices. This is similar to how Facebook shares barely budged after its $5 billion fine when it became official last month. Or, also recently, how markets actually dropped once the Fed cut rates last week. Why? Because the market had already gone up and the news was baked in. Up next, Lyft shares jumped, but 2 other stories should be pointed out as well. Use code revenue growth to get 15% off your first ride. Lyft jumped on word that revenues surged 72% on a new record high quarter. But due to all those discount codes it's been dishing out, revenue ain't the only thing growing for Lyft, so are losses. While revenue may have popped 72% year over year, losses have spiked 360%. Last year's second quarter, Lyft lost only $179 million. This year's second quarter, Lyft lost $644 million. That's for the quarter. That's a run rate of nearly $2.6 billion in annual losses. The kind of good news, while that loss was huge, Lyft says that it thinks 2019 is its peak loss year. Losses should shrink from here on out and hopefully eventually somehow turn into profits. I don't know. While calling 2019 peak loss year may sound good, let's be honest. No company can sustain a $2.6 billion annual loss for very long. The money is going to dry up. So this kind of has to be the peak loss year, at least if the company is going to do well in the future. But then we notice these two other stories, both of which weren't looking so hot for Lyft. Together, they highlight a couple major issues that de-woke the woke Lyft's previous perception of wokeness. Is that enough woken for you? I'm so woke, man. Number one, it's not handling harassment well. If a driver bothers you, Uber has got a panic button that takes just one click to report. The Washington Post notes that it takes a whole bunch of clicks to reach Lyft's safety team, and their responses haven't been up to par. Number two, congestion. It's a problem. Uber and Lyft commissioned their own report on traffic. Turns out a whopping 14% of vehicle miles traveled in San Francisco are ride hails, and about 40% of driver time overall is spent cruising around without passengers. The takeaway? Lyft had one advantage over Uber: reputation. Uber owns more of the rideshare market, offers more services like Uber Eats, and has more big bets that may potentially pay off in big ways like Uber Freight. Lyft, they got one thing and one thing only over Uber: a reputation for higher quality drivers and customer service, which led to the hashtag delete Uber. Lyft cannot afford to lose its one competitive advantage over Lyft: reputation. Hey guys, that's it for this video. Let me know what your thoughts are, or if there are any other stocks you'd like me to check out. I appreciate all the likes and comments, and make sure you are subscribed to Investomania, brother.